I'm Bridget Stomberg.
And I'm Lisa DeSimone.
And this is Taxes for the Masses.
Today's episode is on the Hawaii Accounting Research Conference.
In today's episode, we discuss tax research presented at the 2026 Hawaii Accounting Research Conference in Oahu.
Hello, B.
Hello, Lisa.
Happy New Year.
Happy New Year. Yay for not 2025 anymore.
Do we think 2026 is going to be any better?
I had hopes until the 1st.
Oh, yeah. Uh-huh.
It didn't last at all.
Okay.
But I'm going to hope that maybe it's just growing pains and January is going to be a little rocky and then February we're going to be charting a course for smooth sailing.
Oh, no. I've already looked at my calendar for February and it's a total shit show. So, yeah, I'm just...
March?
I think I'm
May.
I think May is going to be breathing room.
All right.
Maybe April if I'm lucky.
Can we shoot for April?
Yeah.
All right. Thank you. Let's do that.
Well, let's shoot for tax day.
Okay.
Yeah.
I like it.
Yeah.
It's a good quarter.
Yes.
Quarter of the way through.
Yes.
But today I'm happy because we are in beautiful Hawaii.
Is it beautiful or is it raining like crazy right now?
It is. It's still beautiful.
Okay. Yes.
Just cloudy.
I woke up to lightning.
Oh gosh, I did not.
Yeah, there was a big lightning storm, which I've never seen on an island in Hawaii, personally.
Beautiful? Question mark?
Sure.
Okay. I don't know what any of these words mean, but I learned yesterday that I am staying on the leeward side of the island.
Yeah.
Which I guess means it's supposed to be less
windy.
Rainy.
Yeah.
Okay. Mm-hmm. So we did not have lightning this morning.
Lucky you.
Okay. Hoping that it turns around for the rest of the time that we're here.
Yeah, it's not looking good, though.
But hoping.
Yes.
I feel a shift. I feel like I'm trying to bring the optimism and the joy here.
Yeah, you are. And it's really, really freaking me out.
Okay.
So please stop.
Let's move on. So we are here together. We are at the Hawaii Accounting Research Conference. And I know you've been to Hawaii before. Have you been to Oahu before?
Yes, but it's been a long time.
Okay.
I think last time was probably in college. I did one of those package spring break deal thingies. For like $500, I came for a week with a friend.
Nice.
Yeah. Got hit on by sailors. It was great.
Okay. This is a different experience, I'm assuming. Okay.
Yeah, very different.
Yes. Not $500.
No. I haven't been hit on by sailors.
The trip is young.
Yes.
Yes. I was going to say the trip is young. Okay. So as is our usual approach when we are at a conference, we're going to just chit chat about the conference itself for a little bit, and then we're going to get into two papers. Yeah. One that we are co-authors on. Yeah. And another that I discussed.
Yeah. So hopefully we know what we're talking about.
We'll see.
We'll find out.
So what have you enjoyed about the conference so far?
Seeing you.
Same. Ditto.
Yeah.
Yes. Mm-hmm. Weather could be better.
Yeah.
But I have a lower bar because if I were at home right now, it would be 28 degrees.
Yeah, okay, fair. It's at least warm ish.
So I will take warm and cloudy over 28 degrees and possibly snowing.
Yeah. Yeah. That's fair.
What is the weather like in Austin right now?
When I left, it was like 70s and sunny and beautiful.
So you have a different benchmark than I do.
Yeah.
Okay. So we've talked about this before. It's a fairly large conference, lots of concurrent sessions, but they put all of the tax paper, they quarantine all of the tax people.
Yeah, they put us into one room where nobody else has to deal with us.
Yes.
Although several people came and invaded our space. I'm saying that in a weird way. They joined us.
Yes.
Yeah.
We're friendly. We don't bite.
Yeah.
But the thing that I like about that is it gets kind of like a camp feel. You're with the same like 20 to 25 people ish. It was a little smaller this year.
Yeah, I counted 11 this morning.
Oh, well, that's this morning. It's a Sunday morning. Playoff football is happening. Okay. Anything else you'd like to say about the conference itself before we dive into the papers?
Just beautiful setting, great set of papers, nice group of colleagues, nice to see some friends. Yeah.
All right, so we're going to talk about two papers today. The first is what you presented.
Yes.
In a session that I moderated, and I really showed my ignorance because when I introduced Lisa as the presenter, I said she's going to talk about taxes.
Yes. Mm-hmm.
Very, very nondescript because this is a paper we've been working on for a little bit.
It's been a while.
It's been a while.
Yeah.
The data has been challenging
Yeah.
to get from the vendor and then to digest and to work with. And so the joke yesterday was that I learned a lot about our paper from Lisa's presentation.
And I am so thrilled to hear you say that, because I would now like you to describe the paper to our listeners.
Right. Yes. Okay. So let me start with the things I know for certain. Our other co-authors.
Good start.
Brian Grant and Stefan Richter.
Great.
Brian is at Villanova. Stefan is at Illinois.
Great.
And Brian, much like Lisa, used to be a transfer pricing professional.
Yes.
And this I actually remember from practice. So we've talked about this before on the show, but when companies are doing transfer pricing, the IRS has a whole set of regulations on how they can pick the transfer price. You don't just get to pick a price out of thin air. There are several different approved IRS methods that you can use to set a transfer price between two affiliates of an affiliated group. And one of the things that you can do is what we call the cut.
We do call it the cut, yes.
That stands for comparable uncontrolled transaction.
I'm so impressed right now.
And this is a situation where you've got two unrelated parties transacting in a way that is similar to what you're trying to do with your related party. And so if you have a comparable transaction, you can go and you can look at how those two unrelated parties are pricing it, and you can use that to set your own price.
Yep.
So that raises the question, how do you figure out what other people are using as their price?
Great.
And in our setting, we're focused specifically on intercompany royalty rates for the licensing of things like patents and trademarks.
Yep.
So we've got tech IP and marketing IP, as
Excellent.
my co-author astutely described it yesterday. And it turns out that there's actually a database of these royalty rates that public companies, private companies, their tax advisors, and the IRS can use when they're trying to understand what a reasonable cut or comparable price would be. How am I doing so far?
This is really good. I'm just going to interject that this database exists because companies have to disclose these agreements, these licensing agreements that are material to them. So anybody can observe them. It's an SEC required disclosure.
And you used to use this database or some version of this database in practice.
Absolutely.
As did Brian. And so Brian Grant was the one who said, I bet we could just get access to this database. And then we could look to see how the public availability of these royalty prices affects companies' ability to income shift.
Yep.
And then also affects the IRS's ability to maybe crack down on some pricing that it's not a huge fan of.
Because they have access to these agreements as well.
Exactly. So what we are doing in the paper is we are looking at an industry level to start with, whether the number of these royalty agreements, the range of these royalty rates, or the variation, the standard deviation of these royalty rates affects companies' ability to shift income either outbound or out of the U.S. or into the U.S.
Yep.
So the principle that we're looking at is related closely to your dissertation. So can you talk a little bit about why having more prices to choose from, a wider range of prices to choose from, could actually facilitate income shifting?
Yeah, sure. So let's consider the shifting that happens from the U.S. by U.S. multinationals, right? So they have their related party affiliates, some of which are going to be located in high tax jurisdictions, rates higher than the U.S., and some in lower tax jurisdictions. And so having a wider range that supports both a high royalty rate and a low royalty rate would help the company arrange prices with different affiliates facing different tax rates in a tax optimal way.
And so the thing that is pretty cool about our paper is to even be able to do this transfer pricing in the first place, you have to have your IP, you have to have that patent or that trademark in a country that has a different tax rate than where you are. And there's been a lot of work in this area on how tax rates affect the location decision, like where you're going to locate your IP.
Yep.
And so the thing that we're doing that we think is an innovation in this paper is we're now looking at the pricing decision. And we're looking at the pricing decision around a very specific transaction, which is licensing this IP. So we're not looking at services, we're not looking at cost of goods sold. So we're really looking at a very specific method, this cut method, related to a very specific transaction, which is licensing IP between affiliated parties.
And the part that we've been working on recently is leveraging the granularity of the data to better understand whether technology IP versus marketing IP makes a difference in the prices that these companies can choose to facilitate income shifting. Other aspects of the agreements, this is ongoing work, but things like what are the requirements of the licensee or the licensor as party to the agreement. So it's pretty interesting data. And so I think we're taking it a step further than just what is the price of the IP, but also how do the terms of the contracts affect that pricing.
And our discussant definitely did give us brownie points yesterday for cool data. And we have to give some props to Stefan and Brian for all the work that they're doing to exploit like you said, the richness and the granularity of the data.
Yeah, all we do is write and occasionally present.
Let's be gentle with the we there. That's what you do.
Yeah.
I schedule meetings and then cancel them.
That is accurate, actually.
That is what I do. Mm-hmm. Or join late. So I think I at least a B+ in explaining what we do.
Oh, yeah, A-.
Okay. So can you now tell us what we find?
Yeah, so we generally find support across the board, across these different measures of the number of agreements available to companies, the range of prices available to them, and the variation in those prices. That these companies, on average across our whole sample period, which is late 90s to a couple years ago, having more agreements and more prices facilitates outbound income shifting of U.S. multinationals. And then when we split based on before the Tax Cuts and Jobs Act in 2018 versus after, we find a really interesting flip from shifting out of the U.S. when the U.S. had a rate of 35% before the Tax Cuts and Jobs Act to now shifting into the U.S. now that the U.S. has a lower 21% rate.
That was something I learned yesterday about our paper.
That is new. That is a new result.
And
yeah.
I did think that was very cool because, as you mentioned, before the Tax Cuts and Jobs Act, I think the U.S. had the second highest rate, behind Japan,
right,
something like that.
Mm-hmm.
And now with the Tax Cuts and Jobs Act, we're more middle of the pack.
Yeah.
So as the tax rate relative to the rest of the world changes, your incentive changes. And so we're seeing that our results are lining up with those tax incentives, which is always a really comforting thing to see.
Agreed.
And then we all have another test that I always thought was particularly interesting and compelling, and it involves an acronym, so everybody's got to love it. Can you talk to us about what DEMPI is and how our tests exploit our data to look at DEMPI?
So DEMPI is an acronym that stands for the Development, Enhancement, Maintenance, Protection, and Exploitation of Intellectual Property. A lot of the changes internationally in how tax authorities are viewing and how governments are viewing the income shifting activities of multinationals has placed a much bigger focus on making sure that these activities around the intellectual property, the development, enhancement, maintenance, et cetera, are being done by the affiliates within the multinational firm that are claiming the ownership of the IP.
And so what we're able to do with these agreements is we're able to see where some of those activities are actually taking place.
Yep. We show that the royalty rates at the license level respond to the DEMPI requirements of the licensor and the licensee. So if the licensor, the one who's allowing someone else to use the intellectual property, if they're the one that has to do the DEMPI, then the royalty rate that they're charging to the licensee is much higher, and vice versa.
So in that case, are we almost sort of showing that there's some substance behind the royalty rate being charged?
Yeah, to a certain extent, yeah. And certainly that the rates are responding as we would expect them to based on these characteristics of the licensing agreements that we have access to.
So bottom line, I think it's a pretty cool paper. I love having data that people actually use in the real world.
Yep.
And excited to see where this is going to go.
Agreed. We're going to move on to the second paper, which is a really interesting one that you discussed. So this paper is by Jeff Gramlich, Jerry Seidman, and Rosh Sinha. And they take a increasingly common but still relatively novel approach to research, which is semi-structured interviews to better understand how people respond to taxes.
That is great summary of what they're doing. And I think before we talk about the actual research, it would be helpful to understand the setting here and the particular tax that they're trying to understand taxpayers' responses to. So they're looking at Washington State, which is where Jeff works. He's at Washington State University. And as many of you may know, Washington State does not have a personal income tax. Instead, the state typically, historically, relied heavily on sales taxes to generate their revenue.
Which is notoriously a regressive type of tax policy.
Yes.
These kinds of taxes tend to hit lower and middle income households harder as a share of their income. So economists often describe Washington's tax system as one of the most regressive in the country, which is very interesting to me because I think of Washington as a fairly liberal state that I would expect to be very progressive.
Do better, Washington.
And lawmakers have tried for decades to introduce an income tax, but it is against the state constitution, apparently, and voters have repeatedly rejected efforts to override that constitutionality.
So because of that, in 2022, the state legislature tried something different. They proposed a capital gains excise tax, not an income tax, but an excise tax that applies in situations where an individual or a couple generates at least $250,000 in capital gains.
Yeah, and we've actually talked about this on a prior episode.
We did.
When we were talking about Jeff Bezos and his relocation to the state of Florida. The tax affects a very small slice of residents, right? It's only when someone generates, or a household, I should say, generates over $250,000 in capital gains. So these are mostly very high income households, and it only applies to long-term investments, not shorter-term trades. And it doesn't apply to things like selling your house or withdrawing from retirement accounts. So we're really talking about financial securities.
Yes.
Investments in securities.
So very small, very narrow. But as Lisa mentioned, the state had to be really careful from a legal perspective when designing this tax, because as she mentioned, Washington's constitution makes taxing income difficult. So lawmakers got creative and structured this as an excise tax. And we've talked about this before. Excise taxes are typically on goods or services or transactions. And in this case, the excise tax is on the transaction of selling an asset. So they kind of got around it by saying we're not actually taxing the income, we're taxing the sale.
Sneaky.
It's a fine point. And because it was such a fine point, that distinction was actually challenged in court, but the state Supreme Court ultimately upheld the tax.
Which apparently was very surprising to everybody involved.
Yes, and that's something that comes out of the research for sure.
So because Washington didn't have an income tax, the new capital gains excise tax meant they had to create the entire infrastructure.
Entire thing.
So how do taxpayers even file in the state of Washington? So they had to come up with new online portals. They had to come up with deadlines for filing. And a state tax agency that historically dealt mostly with businesses suddenly was interacting directly with individual taxpayers for effectively the first time.
And as you might imagine, the implementation of the tax was rocky because, like you just said, people didn't actually think it was going to go through. So I don't think everyone was running around trying to get this infrastructure in place. I think people thought it was never going to happen, so why bother? And so that's where this research comes in. So the authors are basically asking, how is it that taxpayers respond to a tax that it turns out was actually fairly popular in principle? Because as you mentioned, Washington's a pretty liberal state. People were all in favor of making the tax system a little bit more progressive. So the tax itself, people didn't really quibble with too much, but it was rolled out in what is characterized as a pretty rushed and frustrating way.
And so to address their question of how people responded to this tax, as I mentioned before, the authors conduct semi-structured interviews with 12 tax experts in Washington state. These experts serve higher wealth individuals who were subject to the tax. And I'd love you to tell us more about semi-structured interviews because you've done them before and I have not.
I have, and I've actually done them with Jerry and Rosh. And so it was probably one of the more fun projects that I've ever worked on because, and I'm saying this as an introvert, you get to talk to people.
Okay, who are you right now? You started out all optimistic and now you actually enjoy talking to people. I'm literally staring at your laptop right now with a cactus sticker that says I'm not a hugger on it.
Hugging the people. I was just talking to them.
It's symbolic of how you feel about interacting with other people.
Okay, it all lines up. Give me a minute to explain. What do I love a lot? I love learning.
Yes.
And these semi-structured interviews.
And telling people they're wrong.
Yes. Okay. I like being told that I'm wrong so that I can tell other people that they're wrong. These semi-structured interviews give you a really unique opportunity to learn things that you're not going to learn otherwise because you're not going to see things in the data. Like if someone's frustrated with a tax, that's not going to show up in any data set because oftentimes the state revenue authority doesn't give a crap.
I already dropped shit already on this episode.
They don't give a shit. They're not going to ask, and they're not going to share that with you. So if you want to understand things like how people respond to the administration of a tax, sometimes this is the only way to do it. And when on our paper, the comment we most often got was like, well, just do a survey. But a survey is not going to be as rich because the thing about semi-structured interview is you go in with a list of questions, but as new topics come up, you can switch, you can deviate, you can, chase down rabbit holes and learn things that you didn't even know you wanted to know ex ante.
Cool.
So that's why I think they're pretty awesome.
So you discussed the paper at the conference, even though you are co-authors with 2 authors on this paper.
It's fine, because what did I say?
You said nobody would ever expect you to give a cupcake presentation because you hate everything. Yes. So what did the authors find?
So generally they found that the tax experts they talked to viewed the tax as being fair from the perspective of distributive justice. So basically what that means is people generally agreed it was a good idea to make the tax system more progressive, but the tax experts viewed the tax pretty uniformly as procedurally unjust and punitive. It turns out there are very high penalties from noncompliance, even if it's not the taxpayer's fault that they weren't able to comply with the tax.
Talk more about these concepts of justice and why they matter.
Yeah, this is a really good question. It's a really important part of the paper. So there's some literature out there that suggests when taxpayers or really anybody views a government system as more just, they tend to be more compliant.
Yep.
So in our paper, we talk a lot about this concept in the policing literature. If you think that like the police process is more just and more fair, you're going to be a better citizen. Like you're more likely to comply. On the flip side, when people view a system as unjust, they tend to be less compliant. So really what I think the authors are getting at this paper is how just do taxpayers view this tax and how does that perception of justice affect their compliance?
Okay, so talking about compliance, it's hard not to notice that this tax in particular, it's like really hard not to comply.
Absolutely.
Capital gains are often reported to the tax authorities by third parties like your broker or whatever financial institution you trade through. And so Washington State could access taxpayers' federal returns to see what gains they reported to Uncle Sam. How does the fact that like non-compliance in this setting is probably not much of a thing, how does that impact this research question and what they find?
You are entirely right about that. And it was something that I kind of struggled with as I read the paper. This is a tax that's extremely hard to evade or to avoid if you are a resident of Washington State. And so there were some concerns when this tax got rolled out that the only true way for people to avoid the tax was to give up their residency, leave the state of Washington altogether.
Like, say, Jeff Bezos.
Potentially.
Yeah.
Potentially,
Okay.
yes. Yes.
I mean, we in that episode didn't say that he moved solely because of the Washington capital gains tax, but when an individual is already highly mobile with assets and residences in other states, or maybe they're retired and don't have much keeping them in Washington anymore. And a tax like this could be really unappealing enough to push them over the edge to leave the state.
Agreed.
But for the average person, I imagine that's not very likely.
Agreed on that front, too. And that's actually consistent with the author's findings. Some taxpayers seemed to discuss this concept of relocating with their expert advisors, but it doesn't seem that many chose to do it. I think one quote, they were saying that they prepared like 70 or 80 returns and maybe 3 people left the state as a result of it. So people were not fleeing as some politicians were afraid.
Okay, so then what are we left with here? Like, we have a tax that people like in theory, but they don't like the way it was implemented, or they don't like the having to deal with filing and enforcement and stuff like that. But it's really hard to avoid the tax, and for most people, it's too costly for them to move. So where does that leave us?
Yeah, I think you summed it up, and I think that's where the paper needs to kind of focus on next, is really understanding the implications, what it means when taxpayers view a tax as good from a distributive perspective, but they don't really like the administration of it, but they also don't have many ways to not comply.
Right.
So I do think that the authors have stumbled on a really interesting setting because this is a tax that is so hard to avoid, and I think they could play that up. They actually have some evidence that taxpayers are over-complying with the tax. They're basically paying too much tax too soon just to avoid the penalty. So it's really an interesting setting where they think that the retributive justice, these penalties, are punitive, but it's actually causing them to comply.
Yeah, and it seems like the compliance is almost like fear-based.
Yes.
Yeah, doing what your parents say because you're afraid of them, not because you respect them.
Exactly. And just with that analogy, that could have some pretty negative long-term consequences for the state. Even though it seems like taxpayers are grinning and bearing this tax, it doesn't mean that they necessarily will for future taxes, especially if the state were to try out other taxes that don't have this nice distributive justice component.
Interesting. I also think it's interesting that, these findings highlight that just because compliance on a tax is high doesn't mean the tax is quote unquote working.
Yeah, and I think that's a huge potential contribution for this paper and something that I'm going to encourage the authors to continue to push on.
Let's hope they listen to you. It's time for the good, the bad, and the ugly. And the good is that we're here in Hawaii together.
I'll take it, even though it's cloudy.
Even though I woke up to a lightning storm this morning. Yeah, it's fun to be together.
Yes.
And watch our each other's hair get progressively frizzier and frizzier as we experience the humidity throughout the day.
It's the Bermuda episode of Friends, basically, is what we're talking about right now. Mm-hmm. So this got me thinking, because we're now podcasting in a different state.
Okay, yes.
So I started thinking about all of the places where we have podcasted from.
Oh, yes.
So we've podcasted in Texas.
Absolutely.
North Carolina.
Yeah. Mm-hmm.
Hawaii.
Yeah.
Michigan.
Yes.
Missouri.
If you say so.
St. Louis, ATA.
Yeah, okay. Sounds right.
So those were 5 states that I could come up with. You got anything else?
We've done international. We did
Oslo.
Norway.
Yes, Norway.
Was that the only international? I feel like we've done this before. We were supposed to do Canada, but then you didn't show up.
Sounds like me.
Yeah.
I just schedule meetings and then I cancel them.
Yes.
Okay. But it truly is an international podcast.
It is, yes.
Anything bad you want to talk about?
I mean, we've talked about the weather.
We have talked about 2026. Not really off to a rousing start.
No.
I think one thing I'll say is bad, and maybe we can turn it into a good. This is a really good conference. It's a good opportunity to get feedback from, like we said, a collegial and close-knit group of faculty. Mm-hmm. Next year is the 10th anniversary of the conference. We had actually a little bit of a dip in the number of tax paper submissions this year, so that was not the best. So I'm going to encourage all of our listeners, if you have a paper, plan ahead. You've got, I think submissions are due in August. You've got 8 months to get something to submit to the conference, and then we can be on the Big Island together next year with a bigger group of people discussing awesome papers.
And I love the Big Island. Yeah. So highly recommend. I will not be able to go next year, but because I'll be in Europe. So yeah.
I'm sorry, do they not fly from Europe to Hawaii?
I am not going to fly.
A thing?
I am not going to fly.
Right.
Yeah, our European colleague that attended this conference traveled for 22 hours to get here. So
I traveled for 19.
No gracias.
From the States.
Yeah.
So I guess that's the ugly. We will not be doing this again together next year.
Not next year. Right. Yeah. Also, it's been over 24 hours since I've had poke here in Hawaii, so I need to go fix that.
Let's go fix that right now.
Thank you.
Okay.
Well, that's all we have time for today.
Be sure to join us for more tax nerdery on future episodes of Taxes for the Masses.